You can see the different crises that have happened over the years and so on. Those are the gray areas. Again, this is page 13. But take a look at the actual numbers down below. What's interesting is we've outperformed 15 years. We've underperformed 6. So that's okay. That's pretty good. It's a tough environment out there. But when we outperform, look at the average. It's 126 basis points or 1.25% over the index. Yet when we underperform, it's only 51 under. That's key. Right now, I have competitors that I have been against for years that are showing clients 1,300 basis points under the index, 1,000 basis points under the, and that's basically 1,000 basis points is 10% under the index. Now, how do you think those clients feel when their equity positions are blown to smithereens? And now their bond guy comes in and says, oh, sorry, we're down 10% under the index. Not good conversations going on. But I wanted to share this because we've been through crises before. Each one of these gray areas was a bond market crisis. And you can see that we've been able to get through these, the current one included, in a conservative fashion where our clients were not hurt. So let me wrap up on 15, and again, if you have questions, we can dig into those. 15 is just why would you choose PIMCO? Our goal is the consistent return. We're not the underdog here. The underdog is faced with, gosh, I got to knock off the big guy. I got to go against PIMCO. I better show some real octane in the up markets. Well, guess what? That hurts you on the downside. So the consistency is a real advantage for us. The depth of the resources. We're the biggest. The other shops have some exposure offshore, some don't. It's hard to compete with 400 investment professionals and 11 global offices. It's a big machine. Not lastly, but the next section, conservative value orientation. We're the value players in the bond market. We like this environment. All that premium right now is looking pretty juicy to us. We didn't see that a couple years ago, which is why we took off the risk. Client service. Should you hire us? We have a dual-pronged approach. My direct assignment is with your consultant, Peter Chan. That's how we came to know Jim. But also there would be an assigned account manager dedicated to your group, available for the meetings. Hopefully they don't go through the car rental nightmare I just had getting here, but someone can come to these meetings and make the presentation. And then lastly, educational opportunities. You know, we offer a lot as far as white papers, trying to help people understand bonds. They're a little bit more mysterious than stocks. We offer traveling road shows. If you were to come to one, it would be in San Francisco, and you know, education on bonds and what's going on in the markets is a real theme for us. And also, I would say meeting other like clients. And the last page I'll have you turn to is page 22. Actually, 22 and 23. This is a partial list of our fund clients. And you can see it's very diversified. We list a few corporate plans on 22, along with foundations and endowments. And then the public plans are on 23. You might have some colleagues or industry contacts at some of these other agencies that are in the public realm. But I think the diversity of the client base is actually another strength. We're not married to one client type where if they go down, we go down. You know, this is also a real strength of the firm. So I'm gonna formats. One is a one-pager for those that really don't want to dig into it, just want a flash report. But there are, 2 or 3 pagers that are a little bit more detailed if you want to go that direction. So that's part of what you would get.
That's part of your website. That's there.
Part of the website, or we can push it out on an email too.
The second question is, of course, we're always concerned how much is this going to cost us. And Vanguard is kind of the gold standard when it comes to low-cost investment. And I know that you're in a whole different ballpark than Vanguard when it comes to bonds. But if you take their total bond index and what their costs are compared to your costs, how do they compare?
Right. Our fees are 46 basis points. That includes everything: custody, no loads, no 12B1s, so it's the lowest share class that we have available, institutional share class. So 46, I don't know what the Vanguard fees are. I would imagine they're probably somewhere in the 20 basis point range. One thing to comment about on Vanguard, which maybe they fixed, but in looking at bonds, when you look at something like mortgage-backed securities, okay, Fannie and Freddie and so on, there's a real art to that in the sense that every one of you that has a mortgage here, it's probably in a pool from Fannie and Freddie, but everyone here has an option to prepay that at any time without a penalty, and in most cases. That is a tough analysis to make for a bond manager, and actually somewhere, one of the areas where we excel. We have a big dedication to what we call prepayment risk analysis. Something like Vanguard, where they got in trouble years ago, 2002, was it's a lot easier to buy corporate bonds because there's no prepayment risk, you don't have all these options that you have to work with and so on. And so they took the easy way out, took the yield from the corporates because it was less analysis. Hey, we're an indexer in their eyes. And lo and behold, you had Enron, Tyco, WorldCom, the corporate market got shattered that year. And they underperformed greatly in 2002, yet they were an index fund. Again, making a lot of investors mad. I'm not sure how they've corrected that over the years. Hopefully they have, to where they, there's mortgages in that index. They better own the mortgages and not fade to the corporates. But I can't comment on that. We are active bond managers. We are not indexers. And in an environment like this, a target-rich, heavy-yielding environment, this is, I think, the time for active management.
But if you were to plot Vanguard's total bond index return over a period of 10, 15, 20 years, and plot your return for the product that you want us to buy.
Yeah.
Any idea?
After fees, because that's the right way to measure it, I would imagine we're 50 basis points on top of them, because they're going to try and meet the index,
Sure.
And our long run record is 50 to 75 over the index. So I'm conservative, I'll fade the low side, 50. So that's a 0.5% more on your allocation annually.
So what's your comfort level going into 2009 with the change of the federal government? Any concerns going in?
Well, isn't Obama going to rescue the entire world? Stock market will be at 14,000 by February? No,
I don't think so.
Yes, 09 is going to be rough. 09 is going to be rough. We just had one of our forums just the other day. We do the big one in May and then 3 other ones. And, it's a very damaged situation out there. It doesn't mean that bond investors suffer. I mean, yesterday's move by the Fed brings rates down even more, which actually helped those that were holding bonds at the time. It's probably helped your current bond manager just by the mere fact that now rates are lower and prices went up. But, as far as the economy goes, one thing that we had been exploring seems a little bit off the table, and this was one of the key themes and maybe one of the changes we discussed last week, and that is the idea that the emerging world could bail out the developed world, i.e. the U.S. consumer stops consuming, Europe's not consuming. Can China turn itself from a exporting economy to one that looks internally and says, look, we could improve our standard of living, we could have better housing, we could have motorcycles or cars, we could have better carpet, we could have washing machines. Are they going to be able to do that? And, our original thought, when the crisis was happening was, yeah, they'll probably do it, because if they don't, they're sitting on this big pile of assets, treasuries, and their population would make